Hello and welcome to BloombergQuint. We've just heard the announcement of the monetary policy, the latest round, but also the regulatory policies. The big headline, twofold. One, there has been no change in interest rates. The repo rate and the reverse repo rate have been left unchanged. But the big news on the banking side is that one-time restructuring without a downgrade of asset classification has indeed made a comeback. Joining us to talk about both the macro and the banking aspects, Jayesh Mehta, Treasurer of Bank of America, Saugata Bhattacharya, Chief Economist at Axis Bank, and Jaideep Iyer of RBL is joining us as well. Jayesh, Saugata, forgive me if I put macro to a side for a minute and ask the first question to Jaideep, because I think the big headline is indeed restructuring. Jaideep, what do you think? Was this inevitable? I mean, we'll see the fine print, but do you think we'll slip back into the abyss of restructured loans of the past?
No, honestly, I think it was, in my judgment, a valid request from the banking sector. I think one must understand we are in fairly unprecedented times. I think good companies with business models having no cash flows for 6 months cannot necessarily be penalized, because actually in the Indian context, once an account becomes an NPA, then I think it's incremental funding and all other constraints kick in. So I think this was expected, and I think it's important that there are appropriate guardrails for us to, let's say, not repeat some of the mistakes that may have happened in 2009. But I think this was an expected line, and I think it's a step in the right direction.
All right. I will come back to that in more detail. But Jayesh, sir, the broader thrust of policy, no change in repo, no change in reverse repo, and perhaps a little too much mention of inflation, although they did say that policy space is available.
Yeah, so I think for a first time, or maybe for after a few years, we see actually matching completely with the market. The same thing was expected. Right now, rate cut does not make sense. Plus, it's the last. Members are changing. Plus, their own forecast, and we all know supply disruption or whatever it is. Q2 inflation is going to be higher. They have kind of kept it that it will soften after that, and they will have policy space post that. And most important need for this hour is restructuring, and I think they have given that. So I think perfect situation at this juncture.
Saugata, I know that you had talked about a status quo in your pre-policy note. We still don't have, at least in the speech, a forecast for inflation or for growth. But did the governor's narrative match with yours?
I mean, nobody really seriously thinks that inflation is going to be a big problem, although there's been talk about stagflation setting in at some point. But I mean, I think the trajectory, if not the level, is quite clear. So even we agree that inflation will probably be 6% or above for the next 2 prints at least, and then slowly, gradually decline to 4%. So leave that aside. I think there are some risks, because if global growth actually begins to recover faster than we expect, then commodities prices, metals prices, particularly from China demand, is likely to increase. So that's going to add to some inflationary pressures. But I don't think anybody seriously expects a demand-led inflation. So the only uncertainty was the inflation, household inflation expectations, which is very important for a central bank. And that they mentioned is relatively moderate. I mean, there are no risks there. So the essential part of the policy is quite clearly consolidation. I mean, all the measures that have been taken, the unconventional measures, the steep rate cuts, the liquidity, etc. So now it's time to consolidate. Transmission has happened, as the governor repeatedly mentioned. And now let's see what are the other measures that are needed to increase to reduce the levels of risk perception, risk aversion in the system, and get credit flows out.
All right. So then just to circle back to Jaideep, then can you help us understand how banks will approach this window? I know it's available, but banks themselves are scarred by the last round. Do you see a material difference in how they are able to approach this window this time around?
Yes, I think both from the perspective of the fine print that we will see in the guideline, according to me, and this is the expectations that we had last time. I think banks will be cautious. Banks will generally be giving it only for companies which are directly impacted by COVID and the business plans and and the underlying value preservation is obvious. And we did hear the governor saying that the guardrails will include, let's say, the external, ratification potentially from a credit rating agency and so on and so forth. So I think it will be, it will clearly, in my judgment, not go like the last time where all and sundry got restructured. It's going to be a lot more nuanced, and that is the way it should be.
Okay, Jaideep, I think we're having a little bit of trouble with your audio as well. I will throw that question to Jayesh sir as well because he has long experience in the credit markets. Jayesh sir, there is an attempt to say that we will build in enough safeguards. A committee headed by Mr. Kamath has been set up to set up sector-specific benchmarks and parameters. What is your sense of whether this should have been done or not, sir, and whether it can be done in a slightly safer way?
No, I think I was all for it from the beginning. I do hear there were some dissent saying that we should not be doing it, but let's be very clear. This is a pandemic of nature, which we haven't seen it, right? So you need support. Yes, they have put safeguard, they will have committee, and they were given enough time. So it's not that restructuring. So today they have announced maybe, it will take 6-8 months for every individual lender, borrower to figure it out what it is. And of course, we'll see what KV Kamath's committee gives as the guidelines, and people will follow the guidelines. Now, even with best of the guidelines, best of the safeguards, there'll be some room always for mischief, right? Which can happen. But I think with this situation, we cannot say we will not do it because there could be some. Definitely, it is not going to be an individual bank's discretion. There will be a hopefully proper set of guidelines industry-wise, and they also made it very clear that only for the people who were normal accounts till 1st March 2020. So from that perspective, it's just supporting the pandemic situation and the lockdowns, and it was required, and we have to go for it.
And the release is out, and they asked banks to keep an additional provision of 10% post-resolution on the post-resolution debt. So there are some safeguards. Saugata, come at this question from a more macro standpoint. Is the idea that you need to somehow break this cycle of risk aversion and get banks to lend? And if NPAs had gone up to the levels that the FSR had predicted, no matter how much liquidity you threw at banks, they were just not going to lend.
Yeah, so you're absolutely right. Couldn't have put it better myself. I think look, this policy was characterized by trade-offs. In multiple measures, whether to cut rates, not cut rates, whether to infuse liquidity, not infuse liquidity, whether to provide more incentives for credit flow, particularly restructuring. There are pluses and minuses. So they have taken a nuanced view. Credit is very, very important at this point in time, as Jayesh Bhai also mentioned. In a restructuring process, obviously, there will be some accounts, some exposures that will go past. But I think this was one of the key aspects. Not that this is going to completely increase the flow of lending significantly in the system. There will be other measures required for that. But at least for the accounts, which were basically sound, basically solvent, because of all the liquidity pressures, cash flows, etc., as Governor mentioned specifically in his speech. So that probably it was the basic motivation for going into this. I think this is the trade-off between this not happening and I would think a larger increase in bad assets, NPAs, in the system as compared to what might happen with an introduction of a restructuring scheme like this. Very briefly, the other point that also needs to be mentioned in relation to increasing credit flows, you would have seen a small part on capital relaxations on, I don't know again, I haven't seen the specific measures, on bank investments in debt mutual funds and mutual fund ETFs. So that obviously is a small part. There has been talk of trying to relax the counter-cyclical buffer, the 1%, during this COVID period, because if this is precisely the period to utilize the counter-cyclical buffer, and I have a feeling that this was one part of the capital relaxations that have been done.
Thanks for pointing that out, Saugata. I'd missed it, so I'll ask Jaideep that question. Jaideep, I think what they're saying is that it has been decided that the general market risk charge of 9% will continue to be applied. This is for debt mutual funds and debt ETFs. Thus, the computation of the total capital charge for market risk shall incorporate elements of both debt and equity instruments. Can you explain how material this is?
No, so I mean, I will have to read it again, but I think what the attempt probably was for banks to encourage investments in debt mutual funds, because we did see, debt mutual funds probably going through their own challenges in the light of what happened with one large fund house, and there was a lot of redemption pressures, and banks became risk averse in general in any case. So I think it is possibly tweaking some capital norms which will encourage banks to more proactively look at investments in mutual funds to park their excess liquidity and not put all of that into the reverse repo, which is happening today.
Okay. Jaideep, I know you have to go, so I'll throw one last question at you. So if you look at the summary of measures on banking, there's obviously the one-time restructuring, which will be the headline. There is SME restructuring relief, which is continuing. There is an increase in gold loans, the loan-to-value ratio, and some of this. The big picture to your mind is what?
No, so I think, as Saugata was also mentioning, I think the liquidity has been abundant, the rates have been cut, but banks have been in risk averse mode. Not only banks, actually, all lenders, including NBFCs and mutual funds, have been in a risk averse mode for almost 2 years now. And I think somewhere the attempt is to see if credit flow can be made a little more possible, and encourage banks to possibly look at credit in a slightly more proactive manner. So that I think was clearly because I think it is important for the economy to kind of not really go down further, is to at least because what happens is everybody agrees that this is, let's say, temporary. Whether it's 3 months or 6 months or 12 months can be debated, but it is clearly temporary. And we don't want a situation where many businesses actually do not survive this period, even though they are good businesses in normal times. And therefore, I think all the measures are towards distributing the pain between banks, between giving them more time, giving businesses more time to kind of come back, and banks to play a critical role in supporting them. I think that's really the message. I would have also preferred if they had taken a couple of steps which are being discussed, like increase, potential increase in government securities to STM, because we have this whole issue of liquidity really resulting in appetite of risk. So there are two types of risk appetite. One is really the interest rate risk, and the second is credit risk. So credit risk will have its own challenges to come back. Some steps have been taken. In terms of duration risk, I think still people are quite wary, and long end is struggling given the price of the market. So maybe there could have been a measure to kind of increase the HTM appetite for banks to kind of not take market risk and put there. But maybe the argument could be that then the focus on credit will not be there. So I don't know what went into that thought process, but that helps within the long end of the play.
All right, Jaideep, we'll let you go, and I think you're enjoying the lovely windy day. We can hear it through your windows, but thanks for your time. I'll go across to Jayesh sir and Saugata sir. Okay, let's get into the macro straight off. Jayesh sir, you still see a significant scope of easing from here on in the cycle? I mean, when he used words like there is space, but it has to be used judiciously, what is the message that the market will read into this? Will it suggest to them that maybe there isn't that much more traditional easing to come?
In the beginning, but if you really look at in between somewhere, he did say that Q2 inflation is high, and post that we will have enough room. And I think they will wait for how the situation pans out more on. I think inflation, nobody, as Saugata said, nobody really looks at inflation at this juncture. But what is the impact on growth? And the feeling I'm getting is people are seeing some green shoots, basically the complete low of March, April, and some improvement then. But that's not good enough. I think you went from 100 to 50, 50 to 90 back, whereas we were supposed to go from 100 to 110. So maybe they will take a pause, but I think the room is enough. Growth will be the priority, and I think he was quite vocal about it when he ended also saying that we'll do whatever is required to talk about. And he talked only about growth, and he didn't talk about inflation. That whatever is required to fight the pandemic, to get the growth back, to financial stability, right? I think from that perspective, there is, I think, still room. I see at least 50 basis point room further. Now, when to use it, as rightly said, to use it judiciously, because we will also have to see what government does, because there's some part on the government also needs to be done. And once the lockdown gets over, when people get back to normal, and that's when we will see how the things pan out. And one more point I just want to add is on the mutual fund side. I think first round they did was, as we talked earlier also, like, you have liquidity, slowly the credit risk appetite builds up, right? It starts with CP, then AAA, then AA, and slowly it starts building up. Because if you have liquidity and the deployment, reverse repo, very smartly, they have kind of reduced it dramatically. They have widened the spread between repo and reverse repo, and therefore it kinds of encourage credit risk appetite. But having said that, and having of the legacy issues and all that, where people are worried about, inquiries and stuff like that, best thing is go into mutual fund, right? And therefore mutual funds will do the credit. Now, only thing is, yes, maybe somewhere in the detailed guideline, it will come basically again in mutual. When we say debt mutual fund is fine, but private debt mutual fund should be specified separately. That's where the problems were, right? So I think private debt as in private debt, not as in unlisted debt or private placement. I'm not talking about private placement. An NTPC bond done is a private placement, but private debt loan against a particular asset or something, that needs to be really looked into it. So maybe hopefully they will have some guideline there.
Saugata, do you see a rate cut in the next policy if some of these inflation issues play themselves out, or if the headline growth numbers continue to look really ugly?
So a couple points. So inflation prints will be relatively high for the next 2 months at least. I mean, the next one in July, we are estimating about 6.35. Let's see what the numbers are likely to be. And the next one too will be 6% plus. So if they could not cut at this point in time, it might be optically difficult for an MPC, for an inflation targeting MPC, to cut at the next meeting as well. Secondly, other than inflation issues, my sense is we are already, I don't know what Jayesh thinks of this, we are already near India's effective lower bound, maybe another 15, 20, 25 points, not more than that. In a deposit-centric financial structure, in a system, if you have the stability of the system depends on the accretion of deposits. And we've already seen fixed deposit rates come down very significantly. So, I mean, and this is one of the reasons that retail participation in equity markets, etc., have increased significantly, which might create some financial stability risks down the line. I mean, which is a problem. So, but I mean, given various and of course there is the fear of foreign capital flows if the inflation differentials begin to come down, the interest rate differentials begin to come down significantly. So that's one point. The second point, so I mean, the bottom line is the room to use conventional monetary policy tools is beginning to compress. There's still some space left, not too much. The problem now with this increasing liquidity, with this high levels of liquidity, is that for a monetary for a central bank, the operating rate needs to be the policy rate, close to the policy rate, and effectively now the reverse repo has become the operating rate. For overnight funds, for short duration funds, I mean, it's close to the reverse repo rate given this amount of liquidity in the system. Liquidity itself, I mean, I'm not saying an exit from this liquidity in the next 3 months, 6 months, probably. But at some point in time, the next set of policy measures will also need to begin to communicate the need to exit from this current liquidity system, because that itself will create a whole host of problems down the line, as we have seen in multiple episodes in the past. So these are the two factors that I think the next round of policy measures will need to address.
I'll throw one more question at you, Saugata, since it was the last meeting in the 4-year cycle, and then I'll go across to Jayesh. So, is there a little bit perhaps weighing on the MPC's mind on credibility? I mean, they have to leave for their first 4-year cycle with some credibility on inflation. Could that have been a factor in today's decision as well?
Obviously, I mean, we'll have to wait for the minutes to understand what exactly each member thought. But you saw that was a unanimous decision. So I mean, it was all everybody were voting in the same line. So I think you're right. I mean, the behavioral aspects of a voting member is definitely, I mean, the boundary conditions or whatever economists call it, I mean, would typically be weighing on this. So I was very surprised that despite relatively contained inflation, household inflation expectations, this was what I was a little puzzled. I mean, I was a little iffy whether they would actually hold or not. So despite very moderate inflation expectations, they still chose to hold. And that, to my mind, suggests what you're saying is exactly right, that the fact that they are leaving at or close to these 6% plus above the target rate would probably be a factor.
Jayesh, the last question to you then on the issue that Saugata was raising, twofold issue. One, of course, whether conventional monetary policy may be running out of steam, but also this dilemma in the markets where short-term rates are actually, being benchmarked to reverse repo in the TREPS market, even below that. Long-term rates, the spreads are still very, very high. The RBI hasn't done anything to tackle that. So from a market rates perspective, we will continue to be in this dichotomy, very low short-term rates, but relatively elevated longer-term rates.
No, so firstly, I'll correct myself. As Saugata said, I am not talking about policy rate. Policy rate may be 25 basis point, 30 basis point, or whatever it is, right? But sustained, benchmarking, and this may continue for a year or so. And operating rate being the reverse repo rate, I think the bond yields overall will come down. And then when I'm taking 50 basis point, I'm talking about the bond yields, right? Naturally, as I said, just like a credit curve, credit appetite builds up. It always starts with short term and then slowly moves into the longer term. I think the market has started looking at it. It's just a question of, you need a longer term, slightly medium term, longer term certainty that this liquidity plus the operating rate near the reverse repo rate will continue for some time, it's people till now has come from a situation where they have actually lost money because suddenly the longer term bonds becomes quite illiquid. But I think going forward, as it is, I'm seeing right now that there is some appetite getting built up. It's just a question of more and more people coming into it. And if this rate continues for some time, people will come into longer. And that's why I'm quite confident about the benchmark yields coming off 10-year, 15-year, and all of them coming off from here. I also want to add one more point, which is something maybe in the next policy they can take it. As Saugata said, we are a deposit entity and savers entity. This is the time we should actually activate our small savings. Small savings rates are good, but if you compare their total size with, bankers always complain that's a competition for deposit, but it's not competition for deposit. It's your, it can go to small savings, it come back to you as current account. And that needs to get more popular. Right now we have 19 lakh crores versus banking deposit of 1,35,000 crores. Even if you remove the, PF and all that, which is a mandatory thing, then it's just 6-7 lakh crores, right? And that is giving still attractive rate, and at least for the savers, they can actually use that kind of situation. So I think from that perspective, savers can actually use, but it's very difficult to access that. So I think some ease in this technology world, some ease can be done. We will see a lot of flows coming there.
All right. I'll have to leave it at that for now, but thank you both so much for your initial thoughts. Look forward to speaking to you again, Saugata, Jayesh. So very, very kind of you to join us here on BloombergQuint. Thanks for watching. We will continue to get more analysis, particularly into the restructuring decision that comes up at 1:30. Thank you.